Why do so many investors underperform the market over time? The answer is not usually a lack of intelligence. Many investors are highly educated, successful professionals who understand business, finance, and economics. The challenge is that investing is not just about finding the right stock or predicting the next market move. Successful investing requires discipline, risk management, emotional control, and repeatable process. In this video, we're going to explore the biggest reasons investors underperform and the principles that professional investors use to improve consistency and manage risk. Hey, it's Frank Nagy and welcome to my channel where we help investors understand various market environments, risk management, and alternative investment strategies. If you're new here, subscribe to my channel and hit that like button. One of the biggest mistakes investors make is focusing on making money. During strong bull markets, almost everyone feels like a successful investor. The real test of an investment strategy comes during periods of uncertainty, volatility, and market declines. A portfolio that loses 30% requires almost 43% just to come back and recover. And this is why professional investors focus heavily on downside protection and risk management. The goal is not simply maximizing returns in good markets. The goal is to create a process that can survive difficult markets. The second reason investors underperform is emotional decision making. Markets naturally create fear and greed. When markets are rising, investors often become overly confident and buy after prices have already increased. When markets decline, they sell out of fear. This creates a pattern of buying high and selling low. Successful investors understand that emotion and are one of the biggest obstacles to long-term performances. They rely on rules, position sizing, and a defined investment process. Discipline is often more important than prediction. This is why Theta Bridge Capital Management applies non-directional investment strategies to portfolios with a focus on risk management and market analysis. The firm's objective is to develop structured investment approaches grounded in portfolio construction, risk control, and long-term capital growth. Another common mistake is chasing what has already worked. Investors often look at last year's top-performing investments and assume that those same returns are going to continue. However, markets are constantly changing, and what performs well a year ago is not going to perform next year. A strategy that works during low volatility during a bull market may perform way different during high volatility. Professional investors understand that consistency comes from adjusting to different market environments, not simply following yesterday's winners. Many investors build a portfolio based on what they want to own rather than understand how those investments work together. The portfolio may contain many different investments but still have significant exposure to the market risk. True diversification is not just about owning different positions, it is understanding correlations, volatility, position sizing, and how assets behave during different markets. Professional investors use portfolio construction techniques designed to manage risk. They evaluate questions such as how much capital is at risk, what happens if the market declines, how does the volatility impact the portfolio, and what is the expected return if it's a potential downside. Risk management is what separates investing from speculating. Many investors spend significant time trying to predict what the next market is going to do. They look for the next market top, the next bottom, and a major economic event. The reality is that markets are complex and consistently predicting short-term movements is extremely difficult. Professional investors focus less on prediction and more on probabilities. They build strategies around questions like, what is the expected outcome? What risks are we taking? And what is the potential move? Successful investing is not about being right all the time. It is about management risk and making decisions where probability of success is favorable. The final reason many investors underperform is lack of process. Successful investing is not about finding the right stock. It's about following a disciplined approach for many years. Professional investors understand that avoiding large losses, controlling risk, and staying consistent can have significant impact on the long-term wealth. Most investors underperform not because they lack opportunities, but because they lack a disciplined investment framework. Successful investing requires more than chasing returns. It requires understanding risk, controlling emotions, managing volatility, and following a repeatable process. The question every investor should ask is not only how much can I make, but also how much risk am I taking to achieve that return? Because over the long term, managing risk is what allows investors to stay in the game, invested, and compound the capital. To learn more about DataBridge Capital Management and our investment strategies, risk management approach, and portfolio construction process, click on the links below in the description box.